Let's talk about how private equity firms make their money. Now, the case I'm going to present to you now is, I have to admit, a very simplistic approach, but I want to try to highlight to you how private equity firms rely on deal structure, timing, and three key principles to make their returns from deals. And when you think about it and you get these fundamental structural issues in your mind, none of this is really rocket science. The three principles are arbitrage, leverage, and growth. And I'm going to explain all these one by one so you can really understand where we're coming from. So deal returns, I caveat, are always more complicated than this. But if you just understand these three principles, then you're well on your way to understanding how private equity firms make their returns on deals. So I'm going to discuss a hypothetical deal in which PE firm acquires Company Inc. for $100 million and pays 5 times EBITDA, 5 times the earnings before interest, tax, depreciation and amortization for the business. Now, the 5 times EBITDA multiple is important, and we'll come back to that nearer the end of this discussion. So the EBITDA of the business is therefore $20 million. And the question is, what can the PE firm do with this cash flow to create its return? So note, I'm using EBITDA as a proxy for the cash flow. So the first step is to introduce some leverage into the deal. Hence you get the term leverage buyout, or LBO. So you can see that the total consideration is 100 million and they're paying 5 times EBITDA. But they don't want to use $100 million of their own money. So the first thing they do is they borrow money secured against the company's assets and cash flow to cover some of this consideration. In this case, I'm assuming they've borrowed $60 million from some banks with a 5% coupon. In practice, this will be 200 basis points over LIBOR or whatever the going rate is. But let's just assume it's 5% and it has a 10-year amortization, which means that the capital is paid back over 10 years during the course of the deal. This leaves the private equity firm with 40% of the deal, i.e. $40 million. So they've borrowed 60 million, they're paying 5%, and they have to make 10% repayments every year. So the PE firm, as you can see now, has got the $40 million in the deal, and in practice, this is what it looks like. So the basically the interest cost is $3 million a year, and the 10-year amortization is $6 million a year. And in practice, this would be paid quarterly rather than annually. So the next step to increasing returns is to bring in some high yield debt or maybe some mezzanine. Now, I'm going to just talk about high yield debt because with mezzanine, you often get equity warrants and things which just make the whole picture more complicated, but I want to keep it simple. So let's assume that the private equity firm now raises $30 million of high yield debt. So the assumption here is that the cost of this is 10%. In practice, it could be up to 15%. The high yield debt providers like to get a certain amount of return on their money, so there's no ability to repay this for 3 years. But interest is not paid, it is accumulated. So it actually has no impact on the EBITDA or the cash flow quarter to quarter. It may, however, be a 5-year term loan. So at the end of 5 years, it's either going to have to be repaid or recapitalized. But in the meantime, there's no debt amortization either. It all rolls up. So you've basically got 30% of the deal financed on a fixed basis, albeit expensive, but it's a lot cheaper than equity. So this leaves the PE firm with just 10% of the deal. So this means they've now put up $10 million for a $100 million deal. They've got $60 million of bank debt and $30 million of high yield. But they've still got $11 million of free earnings before tax. In practice, we're talking about $11 million of cash flow, and we would be doing all of this through the cash flow statement in the normal course. So the free cash needs to be high enough to meet the banking covenants, particularly interest cover. So that is important, but there are things you can do with it. So after 5 years of the deal, the senior debt has been paid down to 36 million. The high yield debt has had its interest rolled up, so it's now at 45 million. So debt is now 81 million. So the PE firm's equity, assuming no change in valuation, is now worth 19 million. 1.9 times money. Now that doesn't sound like a great return, but as you see, this is only the beginning of the story. But what about all that cash flow? What about all the earnings before tax? Because there's been this surplus which has been accumulating up, and we've actually not factored that in at all. So the surplus cash either accumulates, it gets reinvested in the business, or it could be paid out to equity holders as dividends. For the moment, we're going to assume that it just accumulates inside the business. So as well as the 19 million of equity, we've actually got, if you look in the bottom right hand corner, $58 million of cash. And that also technically belongs to the equity. Now, if it's used to pay down debt, it means that the equity value has now gone up to 77 million, which is 7.7 times the original investment. And that's still only assuming the original value of the business at 5 times EBITDA of 100 million. So we haven't changed the EBITDA valuation at all, and already the value for equity has gone up to 77 million. And of course, so far we've completely ignored any tax issues. So a quick word on tax, because profits are taxable, clearly, and dividends are taxable when they're paid to the shareholders. The shareholders have to pay the tax, an income tax on dividends. But interest costs and amortization of debt is not taxable because it benefits from a tax shelter. Effectively, you can make these payments before you calculate your tax bill at the profit before tax level. And any tax that is paid in an equity deal like this is dead money to the deal. Now, you obviously have to do everything that you're obliged to legitimately, and we're not talking about tax evasion, but we're talking about tax structuring to get the best result for the deal and minimize tax payments as much as possible and much as making sense, because you want this money working inside your deal and not leaking out to the taxman. Again, I stress it has to be legal and legitimate. So far, leverage is working well for us. And at the end of the 5-year period, I'm going to assume that we repay, because it's come to the end of its term, the high yield debt, which means we have to take 45 million of the cash and pay it down. Now, in practice, it's much more likely that the senior debt would be recapitalized, i.e. they put more debt into the business to repay some or all of the high yield, and the business would keep the cash or distribute the cash to shareholders. A lot of this is to do with tax, and it's also to do with keeping the financial structure of the business as leveraged and as efficient as possible. Don't forget, interest costs are tax deductible. So leverage has worked well for the deal. The returns to equity have gone up very substantially, but we haven't allowed anything so far for this wonderful factor of growth, and particularly compound growth. So what if we assume that we invest $5 million of the cash flow each year into the business and we get the business growing by 10%? Don't forget, for every additional $1 million of EBITDA, you're adding at this point $5 million of value to the deal. So over time, it's also reasonable to expect that businesses, if they're successful, will grow organically. But I don't want to assume there's a free lunch on this. So I'm assuming that the combination of organic growth and investment of the business is delivering this 10% return, 10% growth of the business and of the EBITDA. So we're now adding in $5 million a year into the business, and we're now getting a 10% compound growth on our EBITDA, which means at the end of year 5, our EBITDA is now 32.21 million, not 20 million. So this means that if you just keep the EBITDA multiple at 5 times, the equity value of the business is now 161 million, but we've also got cash at the end of year 5 of 67 million, and before we repay any debt, we have to deduct debt of 81 million, and this leaves an equity value of 147 million. So the business returned to the value returned to equity has now gone up to 14.7 times, but we're not finished yet. The growth of the business has doubled the return to the private equity firm, but we haven't factored in the benefits of arbitrage. Now, PE firms hate to overpay going into a deal, and many would say that most of the deals that have gone wrong went wrong because they overpaid going in. They always want to buy cheaply. They always want to buy low. It's the real keystone success of a successful deal. It also protects their downside enormously if they put less money going in. Now, I've assumed a 5 times EBITDA multiple, which is not expensive. But let's assume, and I'm not going to try and argue it's a 4 times or a 3 times entry point, but let's assume that they are able to sell the business at 7 times EBITDA. So they're getting an arbitrage, they're getting a benefit not only on everything that's going on in the business, but on the price that they buy it at, and they buy low and they sell high, and they're making money just on the difference of the multiple between the multiple going in and the multiple coming out. So we've seen that EBITDA at the end of year 5 is 32 million. At the end of year 6, it's 35 million. Now, if the PE firm successfully argues for a 7 times historic or prospective EBITDA multiple, then they're adding another $64 to $70 million to the deal, which goes straight into the pockets of equity. So because of the leverage in the deal, the senior bank debt and the high yield debt are paid off, and the remaining proceeds go to equity. So you can see how the benefits of growth, of leverage and of arbitrage have had this wonderful impact for the PE firm, putting a small amount of money and making a large amount of money coming out. Now, before we rule off on this whole case, it is a very simplistic case I presented, and I want to leave you with a few thoughts. It's not exhaustive, but a few thoughts of issues which make things more complicated and which you certainly need to have in your mind going forward. So the first of these is working capital. Working capital is the money you need inside to run a business. Now, as businesses grow, they need more cash for their working capital, and this will have definitely eaten into the cash pile. But remember, when you do deals and companies are sold, they do what is called a working capital adjustment, and firms will do their best to strip out as much of the working capital cash as they can. So that this is a really an issue which is really ongoing and is important to the entry point and the exit point of any deal. You have to work out what the working capital is and have the right amount of working capital going in and out, and that impacts cash, and any free cash from the working capital goes into the pocket of the sellers. Now, there's no discussion in this about the assets on the balance sheet, any investment they require, or indeed the ability to sell and lease back some of these assets, as happened in a lot of the big retail deals that were leveraged buyouts in the early 2000s. So there's a whole game to be played there. Now, the PE firm could choose after 5 years to simply recapitalize the whole deal, take a big payday in dividends, and run the deal for another 5 years, and that has happened before. So again, there are different ways to skin this, and you can keep building up the returns, and at that point the PE firm is completely de-risked. They've had all their money back and a big return, and they still own the business. Tax planning, of course, is a core element of any deal, and we haven't really touched on it, partly because I'm not a tax expert, and every deal, the tax situation is always complicated and unique, and you have to take appropriate advice, and I don't want to go and play hopscotch in that particular minefield. Now, there's no discussion either about the role or remuneration to senior management or the employees to an option pool. So there's no discussion about what's called sweet equity, which would also be all part of the equity slice, but it just then means that the cake is divided differently. There's also no discussion of any previous shareholders who may hold a minority position. I'm sort of assuming that this is all wrapped up in the return to equity. And of course, this is the case. The PE firm wouldn't have put in the whole $10 million. There would have been perhaps investment from other people as well. So in practice, the equity capitalization table is always much more complex. We've not really discussed cash flow, which is the critical measure. Now, this is why it's important to have a cash flow model. You need to have a profit and loss account, a balance sheet, and a cash flow, and they all integrate. And you focus on the cash flow going in and out of the deal. I've used EBITDA as a proxy for cash flow, just again to keep it simple. I haven't either touched on the risk element involved in the deal. Don't forget, greater leverage, it means greater risk. And the biggest risk is being run by the holders of the equity, because they're the most junior in terms of liquidation returns if the whole thing goes belly up. So if the deal does not work out, equity can be wiped out. And I've presented to you only an upside scenario. Now, in practice, you'll find that when doing a private equity deal, much of the deal detailed structuring and terms are focused on trying to protect the PE firm from the downside risks, which is why they have preferred stock, they have lots of rights associated with that. It's all about downside protection. I haven't talked about internal rates of return, IRRs. This is a time-based measure of deal success, which I don't want to try to start explaining now. I've just focused on cash returns and cash multiples because they're much easier and simple to understand as a metric of deal success. So to recap, PE firms use arbitrage, they buy low and they sell high. They use leverage, they borrow and use other people's money, but it does include financial risk for them. And they use growth, the compounding growth over time, to increase the returns from the business. And all these three things working in combination enable the PE firms to make their money. So I hope you've understood now, with lots of caveats about the complexity of issues which happen in real life. This is a simple upside-only base case, but it does, I hope, illustrate and explain how private equity firms use these three factors to make their returns from the deals that they do.